Right, hello and welcome to today's podcast. This is Adrian Boothie here from Trend Signal. It's the 24th of February 2020 and today we're talking about the huge stock market falls as the coronavirus spreads. There's plenty of stuff we're going to be getting into today. We're going to be looking at charts, we're going to be looking at opportunities, maybe if there's some support and resistance that might possibly hold some of these big moves. We're going to get into all of that sort of stuff. I'm here with Jerry, who's back from his lovely trip to Australia.
Morning.
Yes, indeed, and very short, very brief. Hopefully, we'll be talking a bit more later on. Let's get into it, shall we? So, there's an awful lot to talk about. So, Jerry, what do we know?
What we know is what happened last week. It was actually up until Thursday, the markets had done all right.
Yeah.
UK markets actually on the week ended up flat, believe it or not, and that's despite what happened on Thursday and Friday. On Thursday, the S&P 500 actually hit a new high, but absolutely peeled off. Part of the reason was some bad data. Part of the reason is the continuing spread of the coronavirus, or COVID-19 as we're supposed to call it, which is sort of now undermining the markets. And obviously what's happened this morning is that there's been significant news about the spread in South Korea, about the spread in Libya, in Iran, in Italy, and the whole thing is looking more like a pandemic now. And the markets are absolutely fearful of that, and we've seen some huge moves. As you can look on this chart here, the S&P 500, just since Thursday, if you look at the top on Thursday, Adrian, I mean, we've come off, from 33.95 down to 32, well, we've been down to below 32.48. We're talking about a 4% move in 3 days.
Yeah.
But still the VIX hasn't moved that much. We're up at 18 and a half this morning. I'm surprised. I think it might have more to it as time goes by. But
it's funny though, isn't it? Because you look at a chart like the S&Ps or the Dow, and it kind of feels like it must have fallen more than 3 or 4%. But just goes to show just how little this market's really been moving to the downside. Really.
Well, look where we are now. If you go back, we're literally back to where we were at the beginning of February.
Yeah.
And then people, the gains that we saw post. The beginning of January debacle with the Iranian US spat, that looks like a little blip. In fact, it didn't need nothing actually.
Barely registered, didn't it? Yeah.
It was a horrible candle on the S&P, but the markets have just rebounded. Is this the start of something a lot bigger? God only knows. The number of times we've looked at calling a top in the market. This phrase, Tina, there is no alternative, still holds sway. Just because we've got a potential global pandemic with COVID-19, there's nothing else to put your money into, Adrian.
This is the problem actually with short selling a booming market, because when you actually do get the turn, and you do get a very big turn, nobody believes it, nobody trusts it, so nobody's really on it. You might get the beginning bit out of it, but to stay short, it's quite difficult, because a lot of the movement down will not necessarily be short selling, it'll be that panic selling from long stock portfolio holders.
Well, that's exactly right. And remember, we've not had the US come in yet, so we're recording this at what's a quarter to 10 to 12 in the morning. We've not got the influence of the US in here yet.
Yeah. And
that will be really interesting. Will they just push it even further, or will they just say, I'll have that, thank you very much? And it's difficult to know at this stage, but it pervades the market. I was looking at Warren Buffett put out his letter to his investors. All he's doing is just buying more and more stock.
Yeah.
He's got a cash pile of 180 billion and doesn't know what to do with it.
What a problem to have.
Yeah, buy your drink.
Eh?
Yeah.
Well, there we are. I mean, we're going to talk about the markets a bit later on when we go through the charts, but massive support level that you can see the pivot point here around 32.45. We've hit that this morning on S&Ps and having a little bit of a bounce. Do we expect much more than that? I don't know. We'll just have to see. We'll take each trade as it comes, really, and let's not get too. What we don't want to be doing is just trying to buy this market just because it's cheap, relatively speaking. I mean, make no mistake, whilst we're down 3 or 4%, actually the definition of a correction is like 10%, isn't it?
Correction is 10%, a fair mark's 20. We've got a
long way to go. A lot of red before we get down.
I mean, what we did at the end of January, we gapped down. If you look at that part, and we just immediately filled it. I say we immediately filled it. We filled it pretty much within
like 3 or 4 days.
Yeah, and That doesn't mean it's not going to carry on legging down first, but I don't know. It might be an overreaction because it looks quite shocking when you look at the news. That's the only thing.
Yeah. Yeah. Okay. We'll see. Anything else last week to get our teeth into?
It was the FTSE market that stuck out very positively for some reason. I think sterling was a bit weak, which always helps the FTSE. I mean, obviously it's absolutely cartwheeled now, but actually on the week it was unchanged.
Yeah.
And you look at it and think, well, why was the FTSE doing so well when the DAX and certainly the US stocks, the S&P, Dow, NASDAQ all came off about 1.5% or thereabouts, which is a reasonable fall, and you'd think the FTSE would have done something about that, but no, it held in there, but it's certainly given ground now with all the resource stocks, mining stocks, the hospitality, airline stocks.
Airlines, yeah.
Oh, EasyJet completely smashed this morning.
Yeah.
In fact, they're the worst one because they are really concentrated in Europe, and that's could end up absolutely killing them.
Yeah.
That's what's being priced in at the moment.
Yeah, well, fear, isn't it? I mean, that's the primary word why markets have taken such a hit, really, isn't it? It's panic selling. It's, oh my God, get me out of this quick, or
it's difficult to know how much will be priced in. The fear is down to the fact that it's now the chickens are coming home to roost, and now there is this potential for a pandemic. And what I think is worrying the markets mostly now is that someone that potentially could be carrying this virus will not be displaying any symptoms, but they could then meet other people and pass on the virus without anyone knowing that anyone's got this virus or not.
Yeah.
And in that case, it becomes very, very difficult to contain it without, you can't quarantine the whole world, can you? It's not going to work.
No.
But that's sort of, nothing's been established at this stage whether that is possible, and it has been transmitted in that way. And of course, we are in the winter. Transmission rates fall as temperatures warm up. You will find in the spring and summer these transmission rates will drop anyway, and then we've got an opportunity to get some sort of a vaccine put together, but that's not going to be ready until sort of the end of this year, really.
Yeah. It's always a bit difficult talking about this sort of thing when people are out there, dying from this sort of disease, but ultimately there's some pretty good opportunities out there, though.
Absolutely.
You keep the emotions part of it and actually just get into the cold hard details of, well, where are the trades. There's quite a lot of them around, and there's some big movements, big opportunities, and we saw, we'll talk briefly about this a bit later, but the FTSE, we had a continuation short on that came in and hit target on for us this morning, a continuation short in line with the longer term downtrends. We had a short trade on the DAX from Friday night, took a massive profit on that one this morning, and the S&Ps as well, which we saw earlier had a massive fall, some really big index moves, and of course what people are doing is they're switching out of these sort of riskier assets. So we're seeing moves up on the dollar, we're seeing, well, actually not as much as you might think, but we're certainly seeing moves up on gold today. Gold up $39 today, massive move up, just straight line trend, isn't it, on the monthlies?
Yeah, it's showing sort of signs of a complete sort of acceleration in it, which basically means there are no sellers anywhere in
That's
gold.
Almost exponential, isn't it?
It is. It's sort of the sign that at some stage it's going to come to a bit of a sharp reversal. But for now, there are no sellers at all. And if you look at the monthly chart, it looks like 1747 I've had in my
well, it's monthly 55 on the monthly, and then we go just tighten up a little bit here, about 48s on the weeklies.
I think
something like that.
And I sort of discussed with a few people last week, and we threw that number out there and said, wow, that's a long way away, isn't it? And you look what gold's done, it's done $100 in a week. More than $100 in a week. It's a big move. I mean, for gold, there aren't any sellers now. No sellers.
I think actually these moves are probably we've seen them before, but what we haven't seen them is much for a while. You know, we've actually had quite a lot of low volatility for the last year or so, so we're not really used to moves like this. You know, the average true ranges of these charts, the foreign exchange markets last year, have sort of tailed off for the last couple of years now, and so actually we sort of get lulled into this sort of lack of movement, and yet here we are back to, I wouldn't say normality, but
it's not
something that does happen more than we've been lulled into thinking, I think.
Yeah, but you only have to look at the bars in the last 3 years. They look like little stubby blips compared to the bars we're getting now.
Yeah.
And you're talking about the average range will be between $5 and $10 maximum, really. But you know, you're talking about this market's gapped up, and it's $40 higher from the previous close.
Well, the ATR on gold right now is up around 15, 16, whereas at one point last year we were sub $10.
Yeah. Well,
so that means, for those of you not aware, the average true range, it's effectively the distance between the low and the high of a candlestick on average, was below $10 at one point last year, or a couple of points last year. Now it's nearly double that. You know. So
but the
opportunity.
You know, we're talking about stuff that's happened last week. We're very much now in risk off mode, and we've talked about this phenomenon before, where investors just take money out of riskier assets, which stock markets are. They put them into haven assets, which is what gold is.
Yeah.
It used to be the Japanese yen, but the Japanese yen was battered the previous Friday when it published its Q4 GDP data that came in negative 6.3%.
Yeah.
Horrendous. And do you think they're going to have a negative Q1? Of course they are. Who on earth would speculate on Japan avoiding a recession? They're going to have 2 quarters of negative growth, and they will have a recession. The thing is, what happens if they have a third quarter of negative growth? I mean, Japan really is no longer, the Japanese yen certainly is not a haven currency. That effect has been waning over the last couple of years, and that's something that is clear to me today. Look at the Japanese yen. Normally the Japanese yen would be through the roof, or the actual rate down significantly as the yen weakened, but it hasn't at all.
Yeah.
You know.
They'll have to cut rates, won't they?
Yeah, cut rates from negative half to negative something else.
Oh, God.
Yeah. Well, see, that's another thing, Adrian. We've talked about what is the alternative to investing in stocks. Over the last month, bond yields have collapsed.
Yeah.
Gone down and down and down as prices have gone higher and higher and higher. And there's no way anyone in their right mind will be investing in bonds. No. Why would you? It's really for the banks and technical investors who need to have their money in some security other than cash. Yeah, that's right. Whereas us ordinary investors, we've got equities or we've got cash.
Yeah.
If you don't want to lose money in the stock market, you put it in a bank and hopefully, and it just stays still. But it doesn't earn you a penny.
Right, so shall we move on to the week ahead?
Yeah, it's not a particularly exciting week, certainly not on the calendar front anyway. It really is. Probably the sparsest calendar I've seen for several months.
Let's bring it up. So what don't we know yet? Here we just give a run through really of what to look out for the week ahead, guys. And as you can see the calendar there, it's
pretty bereft.
You look at last week.
Yeah,
quite a few more bits in there. We'll talk about that in a second. But you actually just see there's just
there's nothing. It's the last week of the month, culminating with Saturday, February the 29th. So it's that extra day we get in February this year. It's the leap year, so we don't start March until Sunday. But there's just nothing coming out. I mean, we've got a holiday in Japan, so that's going to be interesting because the Nikkei is going to have to catch up with these moves tomorrow morning, and the futures are pointing to some significant moves on the Nikkei as well tomorrow.
Do you think that the fact that Japan's on a bank holiday is having an effect on the Japanese yen today, or do you think it'd just?
No, I think
it'd move as it would do normally, wouldn't it?
It would have moved, yeah. I mean, you're right. A lot of the trading obviously will emanate from Tokyo and Japan, but no, they would have priced something in if there had been any reason to do it. But as I said, the Japanese yen has largely lost that safe haven cachet because the economy is so screwed up now.
Yeah. Okay, so what are the highlights for the week ahead? Consumer confidence in the States, maybe?
Well, we've started with this German IFO business climate survey. It's one of these broad surveys. They've got 2 in the month. They've got the ZEW, which is to do with investor sentiment, which was published last week, and that was actually not as positive as it has been. There's been a bit of a bottoming in the negativity in the German economy, and the numbers have started to improve gradually. But last week's number on Tuesday, the ZEW number, was not very good at all. The EFO, which is this really broad-based survey of builders and retailers and wholesalers and services companies, we were sort of expecting it to come in a little bit weaker. Okay, that's the ZEW last week, but as far as the German EFO that's come out this morning, a little bit better. But that actually doesn't take into account what's actually happened over the weekend. So you just think, gosh, the company, the one area or one country in the European Union that could get really hockeyed again, it's likely to be Germany, because there's just no chance of. I think Mercedes sales have fallen by 95% in China. So that sort of sums up their problems in Germany, doesn't it?
Well, you saw. I was listening to the radio a few weeks ago now with Aston Martin, because they're doing a rights issue to raise capital, which is 18 months after their float. I mean, they've been absolutely battered, and one of the main reasons is no one's buying them in China.
No, that's right. Yeah,
and so they're creating a rights issue so that they can afford to
weather the storm.
But also to have an electric car. It's a bit late to the party, I would have thought, but anyway. Own an MPV.
Yeah, that's just madness. Anyway, so and then the Tuesday, tomorrow, we got the conference board, consumer confidence. I like these sort of numbers. This is another what we describe as a leading indicator, something that tells us how things will be in the future with the economy. So the logic goes that if the consumer is feeling confident in the United States, they're more likely to spend. If they spend, the companies that are selling those goods and services to the US consumer will get in more revenue. They'll make more profits, and so the whole wheel turns. And of
course, if we're feeling confident, we go on holidays and all that sort of stuff. So let me ask you: do we know this outbreak in Italy and so on? That's going to hamper consumer confidence, obviously. Is that going to be factored into this data, or is the data already done by then?
It's been done. It won't take into account what's happened over the weekend.
Yeah.
But it will take into account some of the heebie-jeebies that were happening last week. For example, commentators were talking about Apple's news when Apple said it was probably going to miss its Q1 guidance because of the problems with the supply chain. And of course it all makes sense, but it's not just Apple. Surely everyone is. You've heard about Jaguar Land Rover having parts delivered to their motor plant in the UK in suitcases. People are going over to China and picking up parts and bringing them back in suitcases. It's not really the way to run a business, but that's the reality of what could happen. So
drug mules, we've got car mules.
Car mules. Yeah, I've got some spark plugs for you, mate. Don't tell anyone. But it's a big deal, and that's really. In fact, last week it was Goldman Sachs, one of the investment banks, that said that the market had seen through COVID-19 outbreak, i.e., had reconciled what is potentially going to happen, and had priced it all in. And Goldman Sachs, I think it was Goldman Sachs, argued that, wow, surely not. We're on highs. We haven't priced anything in. And as soon as they put that out, Thursday, Friday last week, markets just sort of slipped a few gears.
It's a bit like stating the bleeding obvious, but then, it wasn't so obvious on Wednesday, was it?
Correct. If it was that obvious, we would have all sold it, wouldn't we? But I have felt nervous, and I continue to feel nervous. And someone asked me this morning, do you think the sell-off is a more to go? And what worries me is that the VIX has not really spiked up much.
Yeah, it's odd.
And you just think, if the implied volatility hasn't got up there yet, there's a bit more pain to be felt.
Yeah,
I'd say.
Well, normally you're looking at easy 20s, or for a big crash you're looking in the 30s, low 30s. Just nudge 30, we're nowhere near it. So, for it to be a big crash, a big buying opportunity, we do have a long way to go. Yeah, we'll see. Maybe we won't get that.
But. Precisely. It could be that the US come in, things calm down. The World Health Organization put out an announcement. Italy, the numbers start to sort of quieten down. There's no more increase, but you just don't know. But that's what we know now is enough to set a certain amount of fear in the market. And if the numbers keep on rising the way they have done, then we'll get more selling. That's for sure.
Okay, anything else of note?
Well, I'd ignore the ANZ business confidence number. Well, it'll affect just the New Zealand dollar. That's it, really. And likewise, private capital expenditure. I'm surprised it's actually a high impact number on Thursday, but really it's the GDP data in Canada, which has been fairly lackluster. What you've got to remember, Adrian, is that if you think about it, all the resource shares in the UK have been hit. All the resource currencies have been hit. If you look at the Aussie dollar, have a look at the Aussie dollar chart.
Oh yeah, it's been
got absolutely smashed.
Yeah, it's been absolutely battered.
And battered again today. Although it's recovering a little bit, but that's a fall and a half. It's been relentless this year.
Yeah.
And not surprisingly, because I was out in Perth, which is the home of the likes of BHP and Rio Tinto, and they're feeling the effects of it. There's a real slowdown, and that's China. They're not going to need anything like these resources whilst they're stopping people from working. The whole Chinese New Year was extended by 2 weeks, and it still hasn't really got going. There's going to be a big hit to the Chinese economy, big, and it will hit Aussie dollar, CAD, and the New Zealand dollar for sure.
Well, that means good opportunity for us, I think. So that's the good news. So. Otherwise, a few stocks reporting this week. Quarterly US earnings, 44 in the S&Ps.
Yeah, we're coming to the tail end of the earnings season, as it's called. So we have these 4 quarters that we have earnings. They normally happen 6 weeks after the quarter end, and we're 8 weeks now after the quarter end. So this is these 44 stocks. It's really for the retailers now, so the likes of Macy's, that really beaten up department store chain that as I don't know, was it in Chapter 11? I can't remember, maybe not. Home Depot, or as Americans call it, Home Depot, and Best Buy, which is the electrical goods retailer, a bit like Dixon's. So we'll find out how the retailers are going. I suspect the same deal over here. The bricks and mortar, not so much fun really. And a lot of these companies have a very weak online offering. So that's it really.
Brilliant. Okay, well, thanks a lot for that, Jerry. That's great.
Yeah.
So with the big moves we've been having, let's take a look at what we should be trading this week as we look into the indices, some of the major foreign exchange pairs, some commodities as well. So I'm just going to bring my charts in here, to bring up Charting Center and look at those trend signal indicators. And what we've got to start with, I'm going to take quick look at the indices. So let's start off with the S&P 500, probably the biggest index contract in the world. And what we've had here, big sell-off. We saw this chart earlier. Big sell-off, really starting from the highs on Thursday. Big down Thursday, bigger down Friday, even bigger down Monday. So where are we now? Well, we're hitting that. See that dotted green line there, the 32.44. That's the key price from which this market reversed up off this low. So we've gone to that level now. We've nudged it this morning. We are finding an element of support there. So, it's areas like that we can start to look to pick up buying opportunities, but we do need to be a bit careful. This is a bit like trying to catch a falling knife, and if you try and catch a falling knife, you could well get your fingers sliced off. So just be a little bit careful about trying to buy some of these dips. Make sure you hold your discipline and look for the trades according to your strategies. So, but nonetheless, here we are. Lovely sell trade from Friday, and really quickly falling. It's about 800-900 points lower than where the entry was from Thursday at this point. As we then move on through to actually, let's have a quick look and see what happens if we take that level out. There is going to be a bit of free air down to around this sort of area here, this 30.94. And this is the thing, because the markets have been going up so aggressively for such a long period of time, when it does come off, it could come off really, really hard. And let's have a look at the Dow as well. The same sort of thing here. The next support level down at 27,500, 27,565. In fact, the support level from the Dow, that's based on the lows back on the beginning of December. What we've actually seen us do today is go down and test the lows from beginning of January and the very end of January as well. We're very close to those levels. And what's interesting about this sort of zone is that people will be trying to buy it here because it's cheap and so on, and buying the dips. But if it takes out these levels, what are you going to have underneath these levels? If people are buying it down here, here, they're going to be putting stops below this level here. So if we take out that 28,000 level, we could see it fall quite hard quite quickly, because if you're long and you put a stop order in, that's a sell order, so it will sell your buy trade to close it, which could then lead to a very quick acceleration of prices below there. And to say the next support level on the Dow, 27565. We can also look at the DAX as well, same sort of thing as the Dow. We can see a number of times we've hit that 13,000 level, 1, 2, 3 times there, having another test of it just shy of that pivot point, that dotted green line there, very close to it at the moment. But again, we're sort of hitting those same support levels. Takes that out, and then again we're looking for potentially bigger falls. A long way to go, maybe 1,000 odd points to the next level of support on this one. And so this is what we've got to be a bit careful out. If it takes out these levels, we're looking for big falls. So don't get seduced into buying it down here unnecessarily. If you are going to buy, be careful. Don't go trading massive size thinking this is the biggest, easy lottery ticket going. It's not going to be. It might rally dramatically from here, but if it doesn't, it could fall hard and you could be left with significant egg on your face if you're not careful. So lovely sell trade again from the DAX on Friday's close. Again, falling about 500 points now to where we are. We didn't take all of that out of it with our strategy, but we took a good couple of hundred points out of the DAX there, so really nice trade for us. And then finally looking at the FTSE as well, another wave lower. Looking at this entry point here, this is what we call a continuation trade from the 14th of February. Red arrow on the weekly, red arrow on the monthly, on the far left-hand side of the chart. So we are going for the short trades there, looking for that next wave down, lower highs, lower lows, another wave down here, and here we are moving on really well. Again, getting closed out right on the open on our short trade there. That was a nice profit around sort of 95, 100 points, something like that. A good winner. Lower lows though, that pattern is continuing there. Where are we now? Well, we've hit that support level. Are we going to find it? The next level down to here, 70, 60. You haven't got the same degree of strength in the FTSE as we have had with those US indices. They've been hugely strong, but doesn't mean there couldn't be a good opportunity here. So keep your pencil sharpened. We'll be looking for buying opportunities off this sort of level. We're not going to buy it just because it's here. We're looking for buying opportunities. Do you see? So use your strategies to try and get yourself into trades off some of these levels. Like I said, in FTSE, 71.64, and we've seen the numbers for those other markets as well. What we can also have a look at is a dollar yen. We had a great trade on dollar yen, a lovely continuation trade back from the 4th of February. This is when we're moving back in line with those dominant trends. So we had a buy trade back on the 4th of Feb at a price of 109.51. Faffed around for a few days before moving on really nicely on Wednesday last week. Big aggressive move higher on the dollar against the yen, a big fall on the value of the yen basically, and a nice profit. We've backed off it from here. Why have we backed off from here? Well, we can actually see that if we just tighten the chart up a little bit, we can start to see the resistance levels we've got. In fact, a number of resistance. Look at those red lines there. Do you see that? Put my cursor there, you can see it. We've nudged that level. We found a resistance. It will be interesting to see what comes off this level, because will we start to see a selling opportunity? We might well do. It'll be against the trend, but that could be an interesting one nonetheless. And then finally, we're going to take a look at gold. I mean, gold's been on a hell of a journey for the last couple of months now, and very, very strong in the last few weeks, an almost exponential rise over the last few days there, fighting the trends. Look at this, a movement down there. Very aggressive to take short trades against the trend like this, unless you've got a significant extra reason to do so. Lower highs, lower lows, bouncing off or rejecting resistance. We don't really have that here, okay? And it's just meaning that we want to be getting back on that path of least resistance, which is in line with those arrows. It's an uptrend. We're buying the dips. That's the mode the trend signal traders are in right now, unless we've got an additional reason. Now, I can't really tighten the chart up enough to find the next level of resistance, but I can tell you it's up at 1691. We had a level, we just nudged up to 88 today. 1691 is the next level of resistance, which is all the way back from 2013. We haven't seen gold this high for 7 years, believe it or not. So we're looking up there, 1691, set an alert by it. We'll see what happens if we get up to those sorts of levels as well. But what you are going to get with this is a couple of things with these markets. They're moving fast. What that does is it creates excitement. When you see a big move like this, you're naturally going to think, oh yeah, I must short it because it can't keep going up, can it? It's got to come back down. Someone's going to take profit. Surely that's not necessarily the case. Okay, so it creates opportunity, but it can also create some pretty horrible trades as well. So make sure you're patient, stick to your discipline, stick to your strategy, and don't just get caught up into the emotions and the speed of these markets, because that's when your account can get burnt. Okay, so please, above all, everybody, be careful with your trades. So when we see moves like these on the indices, it sort of brings us into other areas of trading potentially. It starts to think about risk, start to think about stock markets falling and what have been, very strong over the last few years now. So we've talked about short selling. We've defined that. We've talked about the VIX and the fear gauge and that sort of thing as well. In fact, we've talked about a number of things, bear markets as well. We've started to talk about all of these different concepts, but the one I want to go through today is hedging. Hedging is something that not a lot of people do, but it was one of the main reasons that I would think that CFDs were created in the first place. And really what hedging is the way in which you can manage risk on your portfolio. Now, typically you'll be talking about a long only portfolio, so that means you buy stock, you hold stock, and you're hoping the only way you can really make money out of it is from dividend yields and also through the stock price appreciating, not through it going down. But of course there will be periods in which it will go down. In fact, probably 30 to 50% of the time the stock market is falling in a normal sort of period of time. Perhaps not over the last decade, but certainly, well, it has been in the FTSE, that's for sure. The point really being is a lot of the time the markets are falling. So what can you do about that? Do you want to be closing out your investment trades all the time? No, not really. And part of the problem you're going to get with that is locking in capital gain. If you've got a big gain, you don't really want to be closing those trades out because it locks in a tax liability for you. So what can you do about it? If you think the market's going to come off and you're worried about it coming off and you're worried about a particular stock, maybe it's just about to have its corporate results and things like that, and you're thinking, well, I'd like to protect myself. What can I do? I could close the trade out. I could close some of the trade out. But like I said, if that crystallizes a big profit for you, that could crystallize a capital gain tax problem and a tax liability. So what you can do is hedge. And you can hedge in really a couple of different ways. You can do it as a spread bet, but it's not that tax efficient because, any money you lose on a spread bet, is not written off against gains. So really what you need to do is make sure you do it as a CFD. Or as a future, something that has capital gains tax associated with it so that you can offset tax against tax. What that basically means is that if you are holding BP and it's coming into its results and you're worried about it, you've got a big gain, you don't want to see it go back down again, so you just want to hold just in case they come up with a bit of a banana skin or a profits warning, you can short or sell a BP CFD position. What that means is, let's say you long 1,000 shares, you could sell 1,000 CFDs, and effectively whatever the market goes up by on the CFD or down by on the CFD will be mirrored by the underlying stock and vice versa, which means that basically you protect yourself. Now, of course, with a hedge, if the stock market continues to go up, you'd make on the stock, but you'd lose on the CFD as the hedge. But that's fine because you wanted to balance risk. You end up going into a no risk situation, or maybe you only hedge half of your position, i.e. you sell 500 CFDs instead of 1,000. Whatever it is, you're looking to manage and mitigate risk. It's a very clever way of doing it because, again, it doesn't lock in that capital gain, and what you're able to do is just go into a risky situation, a time where the markets, you think it's near a top, but you don't want to close out capital gain. You want to keep riding that position longer, put a hedge on, and help maintain that trade and manage that risk. People also do it with indices as well, right? So let's say that you've got a portfolio of stock again, and you're worried that the stock market is at a high. You could go in and individually hedge the stock, but that's a bit more complex. It probably needs a bit more money. The margin requirements are a bit bigger on individual stocks. What you're also going to need is a bit more costly, a bit more commission costs and so on. It's also going to take a bit more time. What you could do is just balance the value of the portfolio. Okay, so let's say FTSE is trading at 7,000, a pound a point short, or one pound CFD or whatever the trade size might be, will be a £7,000 notional value. So if the FTSE falls from 7,000 to 6,900, your portfolio should, all other things being equal, fall, but so will the value of the FTSE for the hedge purpose, and you'll make on that hedge. The point really being, if you've got a portfolio of 70,000, you could balance that risk to an extent. It won't be perfect, but unless you're portfolios perfectly positioned according to the constituents of the FTSE, but you had a portfolio of 70,000. If you did a short of £10 a point or an equivalent CFD of £10 a point on the FTSE, you'd have a short trade of £70,000 for the FTSE, and you'd have your long portfolio of £70,000 as well, which effectively means you're at a very low risk position at that point. It won't be risk neutral because your portfolio won't be exactly the same as the index, but it will be a lot more balanced than it would be otherwise. It's a much cheaper way of doing it, it's a much easier way of doing it, but it won't be as perfect as the individual stocks themselves. The point really being with this is, if you're sitting on a big capital gain, you don't have to close that trade off and lock in the gains if you're worried about risk and you're worried about that particular stock pulling back in value. You can put a hedge on, manage the hedge, and then hopefully try and go risk neutral while you're over that period of what you would consider to be instability. Now, what you decide to help you to make that decision about whether we're going to have a pullback, that's ultimately up to you, and that's obviously, of course, up to your analysis of the market. Now, of course, we can help you with that with one of our trading webinars and teaching you strategy there. But the purpose of this is to help people to make better trading decisions. If you're looking to manage your risk better from your portfolio, consider hedging at times of instability, at times of risk. You might find that you lose money overall, but is it worth it in order to negate risk? Sometimes it'll help you, and it'll help you to save money too. So look, what I want to do is invite you to one of our live trading webinars, because whilst we do these podcasts, what we'd actually really like to do is teach you one of our strategies. So if you'd like to learn more about Trend Signal, how we trade, you want to learn one of our the 3 simple steps for identifying high probability trading opportunities, get yourself booked in for one of our upcoming live trading webinars. We host 3 of these weekly. They're all live, presented by traders, where you can get in, learn a strategy, ask questions, interact, participate, and end the session as a better trader with more knowledge than when you started, which is a great way of being, learning and progress. Now, in order to book yourself for a free place and find out the upcoming schedule, this is what you need to do. Go to bit.ly, so bit.ly/learnts. So bit.ly/learnts. And if you'd like to tune in more to our podcast, we do them regularly on every Monday, and you can tune in to our podcast, the Trend Signal podcast. Search for that online. Find us on iTunes, find us on the SoundCloud, find us on Spotify. You can even watch and listen on YouTube, or you can go to the horse's mouth and you can go to our blog page as well, which is trend-signal.com/trendsignal-blog. So get yourself to one of those, get tuned in. What we'd like these sessions to be, it's part of your weekly process to helping you to become a better versed, better skilled, better prepared trader to help you make better trading outcomes. All the best, guys. Have a great week's trading, and hopefully I'll see you on next time's session as well. Bye-bye for now.